Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So we have John Friedrich with us today, and John has started out in New Jersey and went to Vancouver and spent some time in South America. So John, it's great to have you on. I want to hear a little more about this story about how you eventually got into commercial real estate.
Yeah. Yeah. Well, thanks, Bruce. Thanks so much for having me on. Yeah, it's been an interesting road. I think I'll give the Cliff Notes version, so not to belabor the point, but yeah, I was born in New York, raised in New Jersey. Both of my parents were investment bankers. My father was in the gold mining business. Um, Roman Friedrich, and grew up in Jersey. A lot of polo shirts, a lot of golf. That sort of world. A lot of wasps. And in 2001, my dad moved us to Vancouver, Canada, which is kind of the cradle of the junior mining business. And um, was great to be in Vancouver. Vancouver is a beautiful city, very multicultural, very global in terms of its mindset. And I eventually wound up in at a school called Chapman, studying film. Wanted to be a filmmaker originally, but then pivoted into kind of advertising. And but I graduated in like 2009. And if for anybody that's lived through that part of history, if you will, it was a very challenging time to get a job. So I did what any sort of kid in my sort of position would, call a dad and ask for a job. And he got me a job in investor relations at a company called Gold Corp, and that was my first foray into finance, and speaking with people with a lot of money to go out and do big capital intensive projects. And It was a great experience. And I eventually joined my father at his firm, Roman Friedrich and Company, where we focused on selling kind of junior mining companies to senior mining companies, primarily in South America, Peru, Nicaragua, Mexico. And it's a fascinating experience. Like you're dealing with very large projects in areas that have a lot of kind of geopolitical tensions, to try to bring these parties together to go and do a very kind of capital intensive project, which is to try to triangulate ore bodies and to extract those resources in the most cost effective manner possible. Um, so spent a couple years doing that, saved up a few shekels, and did what any kid with probably too much money would do, move to Los Angeles and tried to start a tech company. I met a good friend of mine now. His name's Mark Korshak. We had met at a YPO event, and Mark was at Lakeshore, making movies, and I was, up there just taking advantage of too many cocktails. And we got together, and tried to do this app called Snooze, which was an alarm clock to wake you up to your personalized news feed. And this was before Siri and Alexa and all the platforms that we've all kind of come to know and love to today. Worked on that for about 2 or 3 years, burned through all of my money. Um, and lo and behold, like I had to go and get a real job again. And I'd been popping up and down between Los Angeles and San Diego and a couple of different places. And I really, kind of found a place called Venice Beach in Los Angeles, which was at the time, this is flash forward, this is around 2018 or so. This was right when, like, after Silicon Beach had just started to hit, like
Ah,
Snapchat had come to Venice. There was a big program from like Microsoft and Google. They were setting up their like YouTube campuses there, and a big part of that was bringing like this huge brain trust into that area of the city. And part of that program was they would give these senior executives pretty much like credit enhanced loans to go and like buy property throughout Venice Beach.
Oh, oh wow.
So what they did, the property values was absolutely was insane. Because Venice Beach had been like really kind of rough and tumble, like Lloyd's a dog town, all through the 1970s, like lots of gang issues through the
Oh, really?
90s, but
Wow.
it started to really kind of it's always been kind of a counterculture mixing pot of like lots of different types of people, and those types of areas tend to get gentrified.
Yeah.
And and Venice Beach was no different. So flash forward into like the mid 2010s, huge tech infusion, lots of money, and real estate developers followed. So I came into that sort of arena having had the experience with my father, had my experience in the tech scene, and kind of following what was the vibe, for lack of a better term, and of what was going on. And I got hooked up with a couple of good developers in Venice, and worked on a couple of projects in the Venice canals, and that was my first kind of introduction to real estate development.
Uh-huh.
And the business model was to acquire these lots that had not been some of them had not been improved since the 1950s.
Hmm.
If you look at Venice, there's two sections. There's like the areas around the canals, which was developed by Abbot Kinney in like the early 20th century as kind of a Coney Island West. And then inland from there was effectively all GI housing.
Oh,
So the groups that I worked with were developing projects on the canals as well as inland with the GI housing. Projects on the canals, they were extremely difficult to get the seller to sell,
yeah.
because there's only so many of those lots like around the canals. I used to know the figure, but it's not a lot.
Yeah.
And then the GI housing stuff was a little bit more straightforward. Like you have this house that was pretty much a cookie cutter type structure that was left over from the 1950s, and you had like a 6,000 square foot lot, and the house was maybe 750 square feet. So it's pretty
Wow.
easy to kind of like look at the arbitrage opportunity there. When I had started in 2018, you could acquire one of those lots, and this is all within the 2 miles or so of the Coastal Commission, the City of LA, as well as the Venice Neighborhood Council. In 2018, you could still acquire one of those lots and get it entitled and your vertical permits like within about 12 months or so.
Oh, wow.
Uh, now those same projects are your 2 years plus,
Oh, wow.
and the price point has just gone up. So towards the end of 2018, 2019, you could get these lots for about a million, a million two. Scrape the pad, build a 2,500 square foot, 3,000 square foot home, and flip that for 3.5 million. And make a pretty decent margin. But by the time you got up to 2019, going into 2020, that opportunity had left. I'm going to pause there. I'm talking too much. I'm going to hand. I kind of. I
No,
kind of
no,
have.
no.
I'll hand it back to you, Bruce.
Well, okay, but we have to continue the story. So, okay, you got to 2019, and then, of course, the pandemic came across. So, what
Yeah.
happened during that period?
Yeah. So, like lots. So during that time, there was a lot of stress going on, right?
Yes,
Obviously,
for everybody.
with everybody. I had a break with my partner
Yeah.
during that time, and I left Venice and I went north to Santa Barbara and to Ventura with a friend of mine. I remember in March of 2020,
Yes. Yeah. The famous
um,
hurricane.
like my friend had come down from San Francisco. He was with a technology company, and he had like met with a couple of his friends at like Facebook and Google and all these things. He got in March. I was living on the canals at the time. And he was like, John, you have to come over. You have to come over like right now. I'm like, all right, fine. Like, so I wander over there. I was living on Brooks, which is right down from Abbot Kinney in Venice. And he's like, we have to get the hell out of town, like right now. And I'm like, well, I'm like, why? Like, like, yeah, like there's some people that are like sneezing and coughing and like all this sort of stuff. He's like, no, you don't understand. Like, all of the campuses in San Francisco are being shut down. The governor is about to like shut down the city. We have to go like right now. And I'm like, all right, cool. So like, we grab a couple girlfriends of his, and we load into his car, and he's like, where? I'm like, where the hell are we going? He's like, Palm Springs. I'm like, cool. Like all
Okay, no problem. Okay,
no problem. And we book it out to Palm Springs, and it was like something out of a movie, like where like the radio's on, and Newsom gets on the radio and is saying like, like we're shutting down the city, shelter in place, all of these types of things. So we get out to Palm Springs, and it was during this time where I was like, all right, well, what's next? Like the opportunities have kind of dried up in Venice, mainly due to the entitlement timelines. Entitlement timelines have gone from 12 months to 24 months. It was this was even before the pandemic,
right.
And like things were getting really challenging. And like the margin said, like if you take a development timeline for a spec home. From 24 months to 36 months, your carry costs pretty much eat all of your all of your margin.
Your toast,
so
yeah.
So like that business opportunity like no longer made any sense. So I was like, okay, well, what's going on? I'm hanging out with my friend in Palm Springs, and he's like, I think I'm going to get out of Venice. I'm going to go to Ventura. I'm like, all right, well, cool. Like, I'll come with you to Ventura, and I'll figure out whatever the next move is. And it was kind of during this time. This was right when Trump was getting elected the first time, and there was this kind of this sense of like the hollowing out of the American interior that the globalism of like the 1990s had kind of left a lot of middle America kind of had left them behind, and there was this kind of overarching trend of kind of like wealth bifurcation within the United States, the gutting out of the manufacturing base. All of the things that have kind of been crystallized in the media and in Trump's second term. So I was like, all right, well, there's probably opportunity here somewhere.
Right.
And so I started this company called Strata City. And the idea behind Strata City was to invest in underdeveloped MSAs in the American interior, mainly looking at telecommunications, logistics, and ultimately kind of housing and real estate as a way to kind of redevelop these small towns. And we looked at probably 90 different pieces of data, going from like everything from Wi-Fi speed to population growth, zoning, the political environment, all of these types of things to identify the cities that were the most prone for growth if they were just given a chance. And I identified a couple of different places. There was Duluth up in Michigan, Odessa, Texas.
Oh, wow.
Small towns like 50, 100,000 people.
Yeah. Okay.
And I went and I passed the hat with a couple of my my friends in tech, and I was like, all right, look, like the first wave of this is we're going to try to do something called mesh networking in terms of Wi-Fi, because it's like, all right, the first mistake I made was I tried to get into the telecommunications business after being in real estate.
Yeah.
Surprise, surprise, the telecommunications business is very, very complicated.
Hello.
So,
Hello. Yeah.
yeah,
Yeah.
yeah, yeah. So, I go and I pass the hat. I raise, I raise a couple of $100,000, and I'm like,
Yeah.
all right, like let's try to do mesh networks in Duluth.
Yeah.
And surprise, surprise, that business falls flat on its face.
Oh, wow.
Like
Yeah.
so I lose I lose that business,
Yeah.
and like, and that brings me to about 2022.
Okay. All right.
And 2022 was another sort of roller coaster, right?
Yeah.
With
Right. Right.
the rate increases. So I leave that. I shutter that business. I give the tax write-offs to all of my investors. I'm like, sorry, I lost your money. My bad. And, please don't kill me. But thankfully, I remain friends with all of them. But it's never easy to lose somebody's investment, and that was a lesson in and to itself.
Right. Right.
Uh, so flash forward to 2022. I go back into like, all right, I need a real job again. So
Here we are again. Yeah.
here we are again.
Yeah.
And I'm like, all right, well, like, what's going on? I look at the secondary market and look at mortgage trading. So I
Yeah.
join a trading group up in Thousand Oaks called Rams. Great group. I don't have enough good things to say about them. There was a couple of guys out at Countrywide who trade like scratch and dent mortgages, and I was like, all right, like the scratch and dent stuff is cool, but what about residential transition loans? All the stuff that I had been doing in Venice Beach,
Oh,
4 years
yeah. Okay.
prior.
Right.
Like what's the market for a $1 million construction loan that's been originated that has not a yield of this is back in 2022, not a yield of 4%. What if it's 9%?
Right.
And this is 2022 before the rate increases.
Yeah.
So I join Rams, and I do like one or two small transactions, and then quantitative easing stops, and the Fed starts to jack rates, and and like money was flowing, like
Yeah.
was going like
Right.
crazy. And you've got these originators, right? That will originate on their balance sheet. Sometimes it's broken into an A/B note. Sometimes it's just a single source, and they're selling into these large kind of. There's three or four kind of large asset managers and hedge funds that buy up a lot of this stuff.
Right. Right.
Um, and there was these very kind of established channels of like, okay, like we'll buy that at par, or like we'll give you a bit of a premium, and like you're scraping your spread, right?
Right. Yeah.
And so doing a few of these transactions, and then 2022 hits, quantitative easing stops, the Fed stops buying up CMBS and all of this agency debt, and then that hits every other layer beneath them, right? So
Oh,
like
wow.
the taps turn off in like the span of 30 or 60 days.
Oh, no. Wow.
And at the same time, the rates start going in the wrong direction. They start going up and up and up and up and up. So
Right.
all of
Right.
the paper that had been originated for like the previous year now becomes absolutely worthless. So when like a 9% construction loan, like where you would be trading that at par plus one, par plus two, and like the first couple of months of 2022, after the rate increases, you're now 5 under par, then 10, then 20, then
Oh,
25, and now
wow.
construction loans originate like in the 11s and 12s, and like a 9% loan is not even like worth it's not even worth the transaction fee,
Right.
right?
Right.
So that again was a very kind of educational sort of experience. um
Yes. I would say. Yeah.
yeah, so I flipped out of that business after about a year and a half or so. Learned a ton, and worked for a company called IceCap.
Oh,
This is about three years ago or so. We're getting to where I am currently. I'm giving you my full life story.
okay. Okay. All
Um,
right. All right.
so we get to Ice Cap, and like I'm originating small construction loans. It's a group out of New York. Again, great team. Um, but it's like it's small ball stuff, right? It's
Yeah.
like
Yeah.
it's a lot of work to originate a $2 million loan, and at the end of the day, you're making what, 10 grand. So
Mm-hmm.
so I'm like, this is a lot of effort for not a lot of money. Let's try to do bigger deals.
Yeah. Right.
And that's when I reached out through a friend of mine to Blake here at LFB. Blake does, or LFB does large deals. Our minimum transaction size now is $20 million. We did a $500 million um, construction facility in Utah in the middle of this
Wow.
year. We're doing stuff all over the country, all housing, all mainly construction loans, some existing asset, focus exclusively on home builders and multifamily developers. And I run the sales team here now. We've got one associate for each kind of corner of the country, and we're cranking away. So it's been a ride, but seem to have landed all right after all this time.
So, are you doing any mixed use loans?
Yes. So we will look at mixed use properties and doing that sort of financing. The major issue with mixed use is what the tenant is going to be for the commercial.
Yeah.
The lender base typically, to get stuff done, you want to have definitely under 30% of the square footage to be commercial. If you're doing kind of like your standard sort of podium build where you've got where you've got 1 story of commercial on the bottom and then 3 or 4 stories on top, that sort of
Right.
stuff is financeable. But multifamily and mixed use is challenging right now just because of the takeout rates.
Right.
uh,
Right.
so typically, if you're looking at like a mixed use structure right now, unless you've got kind of an LOI from like a high credit tenant, think like a Starbucks or something like that,
Right. Right.
a lender is not really going to give you credit for that space. So you will get a loan, but it'll be a low leverage loan because they're going to be discounting the commercial segment of the building.
Yeah. And I assume if you throw some office space in there, it gets even harder.
Yeah, office is also kind of quite challenging. We don't really touch the office space. We've looked at, and we've had a couple of items sent to us in existing asset in Denver. Denver is a very challenging market right now for office. I think and this is definitely an outsider looking in terms of office. Like you've kind of like you've either got offices kind of out in the suburbs that are very close to where people actually live. And this is anecdotally, that stuff is apparently very financeable. And the super class A stuff that has like highly amenitized, again, like going after high credit
Right.
tenants
Yeah.
in like downtown cores,
Yeah.
that stuff is financeable. Pretty much everything in the middle is very challenging.
Ah.
And I think it's like it kind of makes sense too. It's like what is the appeal for the end tenant, right? Like if you're trying to attract somebody from moving back from like working at home, it's either you need to have a highly amenitized class A building that is like worth the commute to get them back into the office, or you need to be right by their house, like in the suburbs. Nobody is. It's going to be very challenging for companies to get tenants back into buildings that are kind of like Class B, Class C, like the gray box, the fluorescent lights, in some old crappy building, to like leave their home and go to that
Crap,
place, right?
crap the office. Yeah.
Yeah. It's like why? It's like when the argument is that I can just work from home, and it's typically the companies that are leasing that space. Those are small and medium sized businesses. They don't have the same amount of leverage or pull as like take like a JP Morgan or a Chase that like just spent $1.5 billion or whatever the hell on their downtown their downtown headquarters and can mandate people going back to the office.
So what's your crystal ball saying about the future here?
The future of residential, the future of multifamily, what
Well, let's just say the
specifically?
future of lending, lending that you're
Oh,
doing.
yeah. That's a great question. I think rates will start to come down. I think right now we've seen like the home builders, people that are building single family homes.
Yeah,
They've actually had a bit of a bull run because the only way to get a new home builder into a new homeowner into a house currently is to build a new home because the existing stock is locked in place. Anybody that has a 3% mortgage from pre
right. They're
2022,
not selling.
they're not going to sell. So like that inventory is locked in place.
Yeah,
So home builders have had like a really kind of great run. For the last a couple of years. Whether or not that continues, kind of remains to be seen. As rates start to go down and that existing inventory gets unlocked, that'll have an impact on kind of new housing stock. I think we have a general sort of shortage of affordable housing on a national basis.
right.
So like there's always going to be kind of asymmetry there with in terms of supply and demand. So I think new home building will probably continue to be relatively strong. Multifamily is an interesting nut to crack. I think you have a lot of the kind of the COVID bull run type cities, like take your Nashvilles and
Okay.
your to a
Austin.
certain your Austin, those types of places. It's going to take a bit of it's going to take some time to kind of work through that inventory. So I
Yeah,
think, like multifamily development at like large scale in those types of markets, like we need to kind of get through what we currently have before there's real kind of upside for kind of further development in those types of cities.
yeah,
I think, we probably need to see another 50 to 75 basis points from the Fed to really truly unlock multifamily. From construction financing in particular, you're always limited by the takeout loan, right? So you have your LTC, you have your LTV, your LTV, your debt service coverage ratio, and then like stuff like your debt yield, right?
yeah,
It's never the LTC or the LTV really that are the constraints, and to a certain degree, it's not even the DSCR that is the constraint. It's the debt yield requirements for construction lending that really kind of curtails proceeds and drops the equity multiple on these projects. And as rates continue to go down, the DSCR requirements will allow more and more leverage on these projects because if you're an equity investor, right, and you're taking on construction risk, like you want to see
right.
at least see at least a 2x on your money over
Yeah,
like an 18 to 24-month period, right? So if the project can't like go from construction construction start through some level of stabilization and see either a partial exit through perm financing and a recap of the construction loan and ideally some of the LP or an outright sale to a asset manager unless
right.
you can make that jump at least a 2x, like it doesn't really make a lot of sense.
Yeah,
And the perm loans on the back end because of these higher rates when we probably underwrite multifamily like once a week, and the majority of the leverage that we see is like in like the 70s for the construction loan. And you really need to have leverage like up into like the 80s on
uh-huh.
like stretch senior private credit financing to get those equity multiples that LPs have come to expect.
Respect. All right. Well, let's leave it there for the moment. I think we need to talk again probably in 3 to 6 months and see
Yeah,
if the Fed has dropped the rate a little further and kind of what's happening out there in the world of finance because it could all change here in the next 6 months or so. It's hard to tell.
absolutely, absolutely.
Well, let's keep track. That was great information.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.